Imagine this. You've been saving for years. Finally, you decide to invest in that one stock everyone says is going to the moon. You go all in with confidence, and at first, it works. Week after week, the price goes up. But suddenly, the market flips. In a single day, you're down 30%. Panic kicks in. You think, I need to get out before I lose everything. So you sell. And just a few weeks later, that same stock rebounds, climbing even higher than before, doubling in value. The result? You lost money twice. Once when you sold at a loss, and again when you missed out on the recovery. Now here's the thing. This isn't some rare story. This exact scenario happens to millions of investors every single year. And the problem isn't the market or bad luck. The real problem is the same repeat mistakes that most people make over and over again. Here's the shocking part. Over 90% of new investors lose money in their first few years, not because they don't have enough capital, but because they fall into the same traps: overconfidence, impatience, borrowing too much, and letting fear control their decisions. That's why this video is going to be different. Today, I'm breaking down the 7 biggest investing mistakes that even experienced people fall into, and more importantly, how you can avoid them with just a few simple changes. Because the goal here isn't just to protect yourself from losing money, it's to build a strategy that actually works for the long term. So if you want to learn how to invest smarter, stay calm even in the middle of a market crash, and set yourself up for success, stick around. These next few minutes might completely change the way you think about investing. Overconfidence. One of the biggest mistakes most investors make is overconfidence. You know that feeling when you invest for the very first time and the stock you bought shoots up right away? Start thinking, wow, I've got a gift for this. Investing is easy. Pretty soon, you're convinced that every decision you make is the right one and that you've somehow discovered a secret nobody else knows about. But here's the problem. The market is not your friend. It gives you this false sense of confidence when everything's going up, and that's when the real mistake happens. You start holding on to investments even while they're dropping because you're convinced they'll bounce back. Or you jump into risky trades thinking nothing can go wrong. Let me give you a simple example. During what's called a bull market, when prices keep going up, almost anyone can make money, even people with zero experience. But the moment a crash hits, those same people who thought they were geniuses suddenly realize they weren't really investors at all. They were just riding a temporary wave. Overconfidence makes people put huge amounts of money in without any clear plan, refuse to sell bad investments, hoping they'll recover, ignore other perspectives because they think they know more than the entire market. So what's the solution? Honestly, it's simple. Stay humble in front of the market. Even legendary investors like Warren Buffett admit that they can be wrong. The key is to see every decision you make as just a probability, not a guaranteed outcome. Always ask yourself, what if I'm wrong? If the answer is yes, that's actually your chance to protect yourself. Don't put all your money into one trade, and always have a backup plan in case things go the other way. Let's talk about one mistake that a lot of people make: impatience. Investing is not a sprint. A lot of investors, especially beginners, see a stock or a property that looks good, buy it, and expect results immediately. When it doesn't move fast enough, they get frustrated and sell. And here's the problem. Most of the time, it's not the right time to sell, and the investment they just dumped starts climbing right after they exit. This behavior is called chasing opportunities. Every time a new opportunity comes along, people jump from one investment to another without a clear plan or long-term strategy. The result? Constant losses, frustration, and missed opportunities. Here's a concrete example. Someone buys a stock because it has strong fundamentals. The first week, the price barely moves. So after 2 weeks, they sell out of boredom. But once they're out, the stock starts steadily climbing and ends up making significant gains. This is a perfect example of how impatience can cost you golden opportunities. So what's the solution? Patience is one of the most important traits an investor can develop. Focus on long-term goals. Plan your investments for 10 years or more, and don't let short-term market swings shake you. A couple of practical strategies. Use dollar cost averaging to spread risk over time. Evaluate your investments based on fundamentals, not daily price movements. Bottom line, the market goes up and down, and volatility is normal. If you learn to be patient and keep your eyes on the big picture, you'll save yourself a lot of losses and a lot of stress. Segment 3, Over-borrowing. Let's talk about another common mistake, relying too much on borrowed money. Borrowing to invest can be a double-edged sword. On one hand, it can amplify your gains when the market is doing well. On the other hand, it can magnify your losses catastrophically if the market turns against you. A lot of people fall into this trap. They take short-term loans or use leverage without a clear plan. The result, when the market drops, they don't have enough to cover their losses, and what was once an opportunity quickly turns into a financial disaster. Here's an example. Imagine someone buys real estate using big loans. Everything is going great at first, but then the market drops or rental income decreases. The debt is still due, but they don't have the cash to cover it. Suddenly, the stress and financial losses multiply fast. So what's the solution? Don't borrow more than necessary. The golden rule is to use debt cautiously only when you have enough cash flow to cover it. Focus on long-term investments with positive cash flow, like rental properties that generate steady income or projects that yield consistent profits. Always plan for the worst-case scenario. Ask yourself if you could survive financially if the market went against you. Practical tip. For example, if someone has only 15% of their portfolio in secured income-generating debt, they're in a very safe position, even if the market dips. But anyone who jumps into the market with high short-term debt for speculative bets is putting themselves at huge risk. In one sentence, debt is a powerful tool if used wisely, but a disaster if mismanaged. Let's talk about two big mistakes a lot of investors make. Investing blindly, not diversifying. First up, investing blindly. You know what happens to so many people? They see someone making huge gains, or they watch a video on Reddit or YouTube saying, "This stock is going to the moon." They buy without doing any research on the company or the market. The big problem here is that you're basically letting someone else control your money without having your own information or plan. Even if the person you followed is experienced, they're not responsible for your losses. Here's a clear example. Someone bought a stock in January 2021 at $35 because it was hyped everywhere. 2 months later, dropped to $7. They could have made money if they had done their own research and understood the company fundamentals. This is a perfect example of how blind investing can cost you real money. So what's the solution? Always do your own research before making any investment. Listen to different perspectives. Make decisions based on your own investment philosophy and goals. If you don't understand a company or the market, it's better not to invest at all. Second, not diversifying. Many people focus on just one type of investment, stocks, real estate, or cryptocurrencies. That's risky because any market shakeup can wipe out your entire portfolio. Solution? Spread your investments across multiple options. Stocks, real estate, bonds, international portfolios, even a small portion in cryptocurrencies. Carefully. Diversification doesn't drastically reduce potential gains, it protects you from major losses and keeps your portfolio more stable over the long term. Practical example, successful investors' portfolio today might look like this: 30% international stocks, 20% bonds, 25% real estate, 10% cash, 5% Bitcoin or a crypto ETF. This allocation ensures that even if one market drops, portfolio remains resilient. In one sentence, investing without research and diversification is like surfing huge waves without a life jacket, while research and diversification give you safety and the chance for long-term gains. Holding too much cash and selling out of fear. 5 to 6 minutes. Let's talk about the last two big mistakes that a lot of investors make: holding too much cash and selling out of fear. First, holding too much cash. Many people like to keep a large cash reserve, thinking, "I don't know if the market will drop, so it's safer to just hold on to cash." The problem is that this behavior can cause another type of loss: missed opportunities. Every dollar that sits idle instead of being invested is money you could have earned. And over time, inflation erodes the value of your cash. Here's an example. Imagine someone keeps 50% of their portfolio in cash while the rest is invested. The market offers opportunities every year, but they're always waiting for the perfect dip. The result, over time, they miss out on significant gains simply because they waited too long. The solution? Keep enough enough cash to cover 3 to 6 months of emergency expenses. Invest the rest consistently and according to a plan. Focus on a long-term strategy instead of waiting for a perfect opportunity that rarely comes. Second, panic selling. This happens when the market drops suddenly and investors see real losses in their portfolios. The natural feeling? Fear. And this fear often makes them sell everything quickly to protect themselves. The problem? Most of the time, panic selling isn't necessary and it doesn't produce the results you expected. Markets usually recover and the investor misses out on profits they could have earned. Example, someone buys stocks before a market drop. The stocks fall 20% suddenly, so they sell everything. 2 months later, the stocks climb 35%. They lose twice. Once when they sold at a loss, and again by missing out on the rebound. The solution: before selling, ask yourself, has anything actually changed about this investment or company, or is it just the price that dropped? If the fundamentals haven't changed, don't sell. Keep your long-term goals in mind and accept market fluctuations as a normal part of investing. In one sentence, holding too much cash wastes opportunities, and selling out of fear wastes money. Patience and discipline are your real weapons. We've reached the end of the video, so let's quickly recap everything we covered today. Over the past few minutes, we've gone through the 7 biggest mistakes even experienced investors make: overconfidence, lack of patience, overborrowing, investing blindly, lack of diversification, holding too much cash, and panic selling. The big takeaway? Investing isn't a game of luck or a sprint. Success comes from patience, research, planning, and constantly monitoring your portfolio. Here's one last piece of advice. Before making any investment decision, ask yourself, is this investment right for me? Do I understand the risks? Do I have a long-term plan? If the answer is yes, you're on the right track. If no, take a step back and plan before moving forward. Remember, successful investing is a mix of humility, discipline, and patience. Even the biggest investors make mistakes, but the difference is they learn from them and don't fall into the same trap twice. So here's my final thought for you. Invest smart, stay calm, and keep your eyes on the big picture. If you do that, you'll be able to handle any market fluctuations and achieve long-term success. If you found this video helpful, make sure to hit the like button, subscribe to the channel, and leave a comment down below with your thoughts or questions. I love reading your comments and I try to reply to as many as I can. Your support really helps me keep making valuable content like this.